So let's get back to answering the question, how do service, merchandising, and manufacturing companies differ? We've already discussed service companies and merchandisers. Now let's define manufacturing companies. These companies create products that customers want. Examples include Boeing, which makes jet airliners, Monster Beverage, which caffeinates my students and keeps them bouncing off the walls, and Apple, manufacturer of cell phones. More specifically, manufacturing companies convert raw materials into finished products. So, using a guitar manufacturer as an example, let's describe the three types of inventory that manufacturing companies have. The first is raw materials inventory, frequently abbreviated as RM. So what is raw materials inventory? It's the materials used to manufacture a product. So, for a guitar manufacturer, what would some of those materials be? Guitar strings, wood, and glue, to name a few. So another inventory account that manufacturers have is called work in process inventory, often abbreviated as WIP. Work in process inventory consists of goods that have been started but are not yet complete. For our guitar manufacturer, it's simply the guitars that have been started but not yet complete. The last inventory account that manufacturers have is finished goods inventory, often abbreviated as FG. These are the completed goods that have not yet been sold. So for our guitar manufacturer, these are the finished guitars and the display cases that are waiting to be sold. In this class, we'll be talking about these three inventory accounts a lot, so it's critical that you understand them. So let's use a different type of manufacturing company as an example. Linda Lou has started a manufacturing company. She calls it Linda Lou's Lemonade Stand. She operates the business out of her parents' garage. She hired one of her sisters to mix the lemonade and another sister to sell the lemonade. Linda's youngest sister wanted to be involved too, so Linda hired her to sweep the factory floor, also known as the garage. Mom and Dad provide the water for free, but Linda has to buy sugar and lemons. So from the previous slide, I'll bring in the three inventory accounts that manufacturing companies have. Raw materials inventory, which then flow into work in process inventory, which then flows into finished goods inventory. So for my awesome graphical rendition of this manufacturing company, what would be the raw materials inventory? Raw materials are the sugar and the lemons. Water is also involved, but since it's free from Mom and Dad, there is no cost to track. What would be work in process inventory? Any materials that are being mixed are considered work in process inventory. And finally, what would be in the finished goods inventory? Any lemonade that has been finished is in the finished goods inventory. But what happens when some of the finished goods are sold? The cost transfers from finished goods to cost of goods sold, an expense account on the income statement. So when a cup of lemonade is sold, finished goods inventory decreases by the cost of that cup of lemonade, and cost of goods sold, the expense, increases by the same amount. Later I'll show you how this works with T accounts. So let's look at the balance sheet of a manufacturer. At the end of the period, any raw materials not yet used will have their costs combined in the raw materials inventory account. And any products in the process of being manufactured would have their costs combined in the work in process inventory account. And any finished goods that haven't yet been sold would have their costs combined in the finished goods inventory account. It's important that a company keep track of these costs separately, so when the products are finished, the company knows the total cost of the finished product. For example, if Linda Lou is selling lemonade for 50 cents, but she did not realize that it costs 60 cents per cup to make, then her business will not be successful. Now, using a guitar manufacturer as an example, raw materials would be the wood and strings and glue. Guitars that are not finished at the end of the period would be work in process inventory. And guitars that are finished but not yet sold at the end of the period would be in the finished goods inventory. Now let's look at how Cogs, cost of goods sold, is calculated for a manufacturer. First, we need our generic formula for amount used, transferred out, or amount sold. So our generic formula starts with beginning balance. We start not with the beginning merchandise inventory, but with beginning finished goods inventory. These were the finished goods that had not been sold at the end of the previous accounting period. They become the beginning finished goods inventory of the next accounting period. Next on our generic formula are additions. These are additional costs we added this period that are associated with making our product. These are called cost of goods manufactured and includes all the costs of building those guitars, such as the wood, glue, strings, workers who build the guitar, the supervisor, the salary of the janitor that cleans the factory, and other factory expenses such as utility bills for the factory, depreciation for the factory equipment, insurance for the factory, etc. We then add cost of goods manufactured to our beginning balance of finished goods, and that gives the cost of goods available for sale. We then subtract the ending finished goods inventory to arrive at our final number, cost of goods sold. Now that we've given you a pretty good overview of a service company, a merchandising company, and a manufacturing company, let's compare the income statement formats one more time, side by side. Starting with a service company, we start with service revenue at the top, subtract all the expenses to get operating income. Expenses and revenue that are not part of the main operations of the company, like interest expense, interest revenue, and taxes, would appear below operating income. But for our purposes for now, and to keep things simple, we can consider operating income to be net income. The income statement for a merchandiser is a bit different. Notice we have a cost of goods sold section. Also notice that the formula follows our generic formula. We take the beginning balance of merchandise inventory, plus the additions, which is purchases and freight in, and this gives us cost of goods available for sale. We then subtract the ending balance of merchandise inventory to get cost of goods sold. Also remember that cost of goods sold is a product cost that a service company would not have. We then highlight our subtotal, gross profit, which in this case is $4,000. Then we subtract our period costs and place them in the selling and administrative expenses section. Remember, period costs just means they are costs not associated with a product. Then we arrive at operating income. A manufacturing company is very similar to a merchandiser. They still have cost of goods sold, and they still have gross profit, but just the terminology is different. To calculate cost of goods sold, we still follow our generic formula. We take the cost of finished goods inventory at the beginning of the period. We add the cost of goods manufactured. Remember, this is the cost it took to make the products. We'll describe this more in detail later in this chapter. That gives us cost of goods available for sale. Then we subtract ending finished goods inventory, which gives us cost of goods sold. Then, just like for a merchandiser, we have gross profit, followed by the subtraction of selling and administrative expenses, which gives us operating income. Now let's compare the balance sheets of all three types of businesses side by side, but we'll only compare the asset sections. Notice the service company in their asset section has no merchandise inventory account because they have no inventory. Next, a merchandise company does have inventory. It's called merchandise inventory and is listed in the current asset section of the balance sheet. This represents the cost of the inventory that has not yet been sold. And then we have a manufacturing company. They don't have just one inventory account, they have three: raw materials inventory, work in process inventory, and finished goods inventory. These inventory numbers represent the cost of those inventories to the company.